So here we are, finally back. Season 3. I guess this kicks off season 3. You excited to be here?
I am.
All right. Well, we're super happy to have you here. So the reason that this show has come about is because we were getting close to tax season. Not sure if anybody listening has to do taxes. I would imagine that you probably do. It's your duty, right? I mean, everybody's got to pay taxes.
Once a year.
Yeah. People try to avoid them, I guess, as much as they can, proper tax avoidance. So, but Patrick Cooper here is a CPA. And if you would, go ahead and talk a little bit about your company. But before you do, we do want to acknowledge to everybody that we're just going to be having a conversation about taxes. This is not to be construed in any way to be tax advice. And your particular situation is going to be unique to you. And to any tax advice, we would totally recommend that you seek out a CPA like Patrick or whomever and ask them for some tax advice. But right now, we're just going to kind of give you the nuts and bolts of taxes, some of the things that Patrick's identified that, there's some loopholes. Loophole is probably not the right word. But there are some things that came about related to the pandemic last year, and Patrick's going to give you some good guidance. So welcome to the show formally, Patrick. How's it going?
Good, thank you. I've been a CPA for 35 years here in the Houston area. I've lived in Houston my whole life, so I make Pearland my home. And as you know, in the last 2 years, we've had lots of changes in coronavirus rules and new tax law, and it's not easy to do your 1040 anymore.
Right, that EZ should stand for something else.
Yeah,
huh?
the IRS eliminated the 1040 EZ. That form's not around anymore.
Oh,
so
really?
Now you just file the 1040 if you have a simple return, just like everyone else files a 1040.
Oh, okay. When did they change that?
A couple years ago, they just decided to get rid of that form. They're trying to streamline the number of forms they have. So
Okay. So that was one way to do it. Was that where people are saying, well, it's not too easy. I don't know why they keep calling it easy.
right.
I mean,
That's right.
try to cut off some of that?
Right. But my practice mainly focuses on helping people who have their own small business do the business taxes, and also for people that don't have a business that just need help doing their 1040. Either it's more complicated than what they can do on their own, or they have an unusual situation, or they have maybe income earned from another state. They need, a CPA to help do more than one return. So in my practice, we see a little bit of everything.
You get some of the laundry, huh?
Right.
That's good. And I guess that obviously everybody thinks about taxes around this time of year, but it's probably something that you should maybe think about year-round, right?
Especially if you have high income, higher than normal, you probably ought to do some planning during the year so you're not surprised when it comes tax time.
Okay. Yeah, no, that's great. So I guess we can let's jump right into it a little bit, I guess. We've got here some 2021 tax law changes. So I'll just kind of cue these up. We've got the child care credit. So if you would kind of talk a little bit about that, and then some things to think about.
Yeah, the child care credit is for parents. It could be a married couple. It could be a single parent that has dependents listed on the return, has children listed on their return as a dependent. And they have to pay during the year to have the children, watched either after school or during school with either a daycare center, or have someone come in the taxpayer's home and care for the kids inside the home. If you're paying fees to have someone watch your kids so that you can go to work, there's a tax credit for that. And it's called the child care credit.
Okay.
And it's a lot larger now in 2021. And years before 2021, only $3,000 of expenses that you pay to a daycare facility per child could count toward the credit.
Oh, wow.
Now, $8,000 of expenses per child
from $3,000 to $8,000
can count. Yeah, so
wow.
it's a huge new increase in a tax credit, which everyone who pays that should take advantage of it because tax credits reduce your tax dollar for dollar, whereas a tax deduction just reduces your income. It doesn't reduce your tax dollar for dollar. A credit is much better. So
Okay, so if you made 50,000 a year and you had a tax credit or a tax deduction, that would reduce the 50,000.
yeah, down to whatever amount would be subject to tax, whereas a
Okay.
credit comes right off the tax that is levied on all of your income.
Okay, so if you owed 4,000 and you had $1,000 tax credit, that would be reduced.
Yeah, you'd
down
only
to
owe 3,000.
Okay,
So,
nice. Yeah, that's one
yeah.
word, huh?
And this is a game changer for a lot of parents who went back to work after COVID and had to put their kids in daycare while they went to work. This is what this increased credit is for, is to help them. Because the IRS understands that a lot of parents who had to go back to work needed help,
Oh my
juggling
gosh.
it all.
Yeah, definitely. I mean, it was a huge burden for people that were just stricken by how to move forward and all of that. So yeah, it sounds like it was a good credit.
The one thing to note on this though is you can't just have one parent go to work and the other parent be stay at home not working at all. The credit only applies if both spouses have earned income during the year.
Oh,
So
okay.
it's to encourage, if the husband already had a job and the wife stayed at home and watched the kids, and then she got a job and went back to work and had to put the kids in daycare, it helped her to go back to work so that both husband and wife would get the credit. The credit
Gotcha.
doesn't apply if both spouses don't work.
Okay, what if you're single?
Same thing. If you're single and you had to go back to work, you have earned income. You're working, getting a W-2 or having your own business at home.
Mhm.
That's considered earned income. You would qualify for the credit.
Okay. Is there anything to think about in regards to if you worked maybe part of the year or is there any kind
As long as you have some earned income during the year, you can qualify for the credit potentially.
for the
Yes.
full credit?
Yeah.
Oh, nice.
Yeah.
Okay.
Even if you work part-time or work part of the year, as long as you had some earned income, that would enable you to potentially take advantage of this credit.
All right. Well, that sounds like a good thing, both in getting the 8,000, but also, the credit and the money's along the way. So that's great.
Now, the credit may not be a full 8,000. The expenses that count toward the credit max out at 8,000 per child that you're spending on daycare cost.
Okay.
And then the credit will be some percentage of that 8,000.
Gotcha.
Yeah.
Okay. See where it's going now. So yeah, that's a great start. So excellent. The next one we've got advance payments of child tax credit in 2021.
Yeah, the way that worked is because of COVID, the government knew that parents were still struggling with, trying to pay the bills. And what they wanted to do was any child tax credit for having a child on your return as a dependent, beginning July of 2021 through the end of 2021. So it only went for 6 months. Instead of you having to wait and get that child tax credit on your tax return in April, they gave you that advance into your bank account beginning July of 2021. So each month, they automatically sent you some money into your bank account as a pre-advance of that child tax credit so that you could kind of get it ahead of time.
Okay.
And that pre-advance ended in December of 2021. So it's not happening anymore here in 2022, but all it was a advance of cash to you so that when you do go file your 2021 tax return here soon, any advances you got ahead of time, you have to report them on your return because they're going to reduce the normal child tax credit you're going to be eligible for because you've already got some of it sent to you in your bank account.
Okay.
So it's important for parents who either are trying to file their own return, they can't forget that if they got those advance payments sent to their bank account in the latter part of 2021, they have to answer those questions in the software they're using that ask, did you get advances of the child tax credit? Now, this is different from the child care credit. This is a second credit. It's called a child tax credit. It's for just having a child on your return as a dependent, whether they go to daycare or not. It's a child tax credit that's always been around. It's just, it's higher now in 2021 than it has been in the past. And the government sent out advance payments of that credit in the last 6 months of the year.
Okay.
Another complication that
Right.
needs to be addressed when you do your tax return for 2021.
Okay. And again, you're not having to pay any additional taxes or anything like that. It's just kind of like a book advance or something like
It's an advance. If you end up if your income was really high in 2021 and the child tax credit maybe gets phased down and you ended up getting too much credit sent to your bank account, you may have to pay some of it back on your return. There's a form that will reconcile it all in the return. But again, it's another wrinkle that happened in 2021 that wasn't around in 2020.
Yeah, definitely. No, that's some good stuff, and definitely another good reason to talk to other people in regards to taxes and trying to understand this stuff. So awesome. Okay.
Now, one caution on that is some people may say, "Well, I don't remember how much the government sent me in as an advance to my bank account. I don't remember." The IRS mailed out letters to every taxpayer who got those advance payments. They mailed the letter out here in January of 22 that kind of showed you how much you got in case your records were incomplete at home or you forgot how much you got. The IRS is sending reminder letters out to people that says, "Here's what you got as an advance payment. Please remember to, reconcile it on your tax return."
Please.
So,
Does the IRS ever use the word please?
no. Yeah, that letter number is letter 6419.
Oh, okay, great.
And I think if you got the letter here recently and you've misplaced it or lost it, there's probably a way on the IRS website that you can log in and get the same information from the website if you can't find your letter.
Oh, okay. No, that's great. Probably have to give them 5 pieces of ID in order to get it, but
probably will.
Excellent. Okay. Moving down, continuing with the child tax credits. It was increased, I guess, in 2021.
Yes. In the past, every year, if you had a child on your return for the child tax credit, the maximum credit per child was $2,000 a year, which is, again, it's a dollar for dollar reduction off your taxes. It's a great thing. But the IRS has really increased it here for 2021. It's now a maximum of $3,600 per child.
Dang.
If they're 5 years and under. Any child between 5 and 17, instead of being $2,000, it's $3,000.
Okay.
So for really young children, it's $3,600 max. For kids that fall between 6 and 17, it jumps to $3,000 max. So again, it's another nice bonus that the IRS is giving families that have children.
Yeah, no, that's awesome. Definitely. I heard a lot about the COVID babies, but if anybody's doing some tax incentives, maybe that was definitely the year to have some kids.
Right, tax planning.
Yeah, great tax planning. So awesome.
And again, with anything with the tax code, especially with credits, a lot of these credits start to be reduced on your return if you and your husbands are combined, or if you're a single person, if your total income on the return is over a certain amount. These credits get phased down and kind of reduced.
Okay.
The government kind of wants the maximum credit for people that are, in the lower mid to lower brackets to benefit the most from it.
Sure.
People that are in a little higher income brackets probably won't benefit the max, but they may get some.
Nice. I think that seems like a reasonable way to handle it. All right. So I see that we've got something here called the EIP Stimulus Payment number 3. That sounds like a lot of stuff there. You care to unpack that, as they say?
Well, yeah, let's talk about it. When COVID first hit in March of 2020, the economy took a hit. People weren't able to go to work. A lot of folks were laid off, furloughed. So beginning in April of 2020, the government sent out what were called stimulus payments to people. And it was money that went right into your bank account or a check mailed to you. And the first one was stimulus number 1, and it went out around April, May of 2020. And it's not taxable income. It's like free government assistance to families to get them through the COVID.
Sure. Yeah, they had the printer on.
Right.
Hey, run a couple more copies of it.
The maximum was $1,200 was given to people per person, and it was another $600 for a child. So a family, could have gotten a $3,000, $4,000, $5,000 check for stimulus number one. Stimulus number two was issued right at the beginning of 2021, and it was a lot lower amount. It was $600 a person, so it was about half of what the first one was. Those two stimulus, since they came out in 2020, they kind of had to be reconciled on your 1040 tax return when you file for 2020. Stimulus payment number 3 was sent out again in the early part of 2021, and it was a maximum of $1,400 a person. So the way it works is when you file your 2021 1040, there should be a question on the return that says how much stimulus payment did you get from the government, and you have to enter it or report it. And if you ended up getting too little, let's say because your income levels were high, you didn't get your full $1,400 that was mailed to you, you got less. When you file your 2021 return, if you're eligible to get the full $1,400, you show that you got less, and the government gives you the difference on your 2021 return as an extra refund.
Okay. So kind of one more way to get you.
Or to lower your tax if you end up owing tax. So stimulus number 3 has to be addressed and reconciled when you file your 2021 return, just like number 1 and number 2 had to be on your 2020 return.
Okay. That sounds good. But again, I guess when these payments were sent out, they were kind of guesstimates. They didn't know, maybe people's working would change. So they
They were guesses, yes. And sometimes if you ended up getting too little, you'll get more. If you ended up getting too much, you don't have to repay the difference.
Okay.
The government has made it clear that if you ended up getting too much and when you do your return, it shows that you got too much, you don't have to repay the difference.
Okay, great. Awesome. More good stuff. I think that those, and I guess, was there a stimulus number 4 hanging out there?
No, they haven't announced that.
Okay. The way inflation's going, I don't think they're going to get into number 4, are they?
They may have run out of money by now.
I don't know. I think they'll run out of toner before they run out of money, it seems like. All right. So those are all great stuffs for family. As you mentioned, we've got businesses. A lot of people, we heard about the great resignation. A lot of people are like, hey, I don't need to, work for some other Yahoo. Let me go work for myself, work at home and do some stuff. So there's some business, deductions and people kind of going in for the first time, entrepreneurs, and entrepreneurship continues to be. So what kind of taxes do you see in regards to, anybody that maybe had a home business?
Well, one of the biggest changes for 2021, and it also applies for 22 also, it's a 2-year thing, is whenever a business incurs a business meal, they're either taking a customer out to a restaurant for a business discussion, or they're taking their employees out or a potential customer. In the past, the business could only write off half of the cost of the meal in a restaurant setting. The IRS has changed that. The IRS knows a lot of the restaurants are still struggling with customers coming in. So for 2021 and 2022, any business that pays for a meal cost can deduct 100% of the meal costs.
100%. That's awesome.
Yeah, it's a big deal for 2 years.
Okay.
And that applies too if the business brings in food and has it inside the office for the convenience of the employees for lunch or maybe an early dinner if they're going to work late. Any food brought in and paid for by the business is 100% write-off also.
Oh, okay. Because it used to be in the past, you had to kind of talk about business with someone else that wasn't with your company, but you're saying just kind of any kind of business meal. Huh?
Any business discussion where as long as the main part of the meal is to talk business in some manner, you could be talking to your employees about, goals for the next year, their performance. You could be giving them feedback. As long as it's business related, you should be able to deduct it.
Okay. And if I had my own business and I was, hitting Uber Eats every chance I got, all of that is going to be
I would say
deductible?
yes, if you could substantiate that the reason why you had to bring food in to your home-based business is because you needed to stay at your desk and, take calls while you're working from
Right.
clients or maybe answer emails while you're eating. You could probably argue that the meal is business related.
Awesome. No, that sounds good. And again, reminder to, your own specific situation. These are all just suggestions and not in any way to be construed as financial advice. So, what else in regards to business meals or business accounts?
Well, a lot of people don't maybe not know this rule, but a couple years ago when Trump passed his tax act, and it's not his fault, but when he passed a tax act at the beginning of 2018, they changed the definition of what's called entertainment. A meal is different than entertainment. A business entertainment cost would be something like if a company wants to buy, let's say, Astros tickets and hand them out to their employees or hand them out to customers.
Nice. That'd be a good one. Yeah.
Yeah. Many years ago, the cost of the ticket that was paid for by the business would be recorded as under the category of meals and entertainment. And under the code, only half the cost of the event ticket would be deductible by the business on their tax return. Beginning in 2018 going forward, the IRS changed the rule and says any entertainment cost that a business pays for, not a meal, but entertainment like tickets, opera tickets, sporting event tickets, maybe golf. If you take a customer golfing at a golfing place,
Sure, nice.
None of that cost is deductible by the business.
None of it.
They cut it out.
Gave it a big zero. Seems like a lot of these things are real positive, and they actually took something away. Huh?
Yeah, so I'm sure a lot of the golf courses and sporting event places weren't happy because they relied heavily on businesses buying their services and handing it out as perks to customers or whatever. So, and this rule goes from 2018 through 2025. It's a long-term change. It may get reconsidered at the end of 2025 and change back to the way it was before, where half of it was deductible. It may stay as permanent, but beginning in 2018 forward, business entertainment costs are not deductible at all.
Wow, that's an interesting one. Yeah, because what would be construed as entertainment then? Because I know, sometimes people have happy hours and that kind of thing.
If the happy hour just involves food and drinks, that still would fall under meals. But if it involves, attending a function like a game or a concert or going to the opera or taking your client to the racetrack or taking your client to a golf course, none of that's deductible. That's considered entertainment.
Yeah, that's interesting, especially golf courses, knowing that prior Trump was big into the golf courses. Yeah, you think that wouldn't have been one of the things in there.
Yeah.
The other thing that comes to mind is what if I go to a Skeeters game? Now they're called the Space Cowboys, the local farm club baseball team. What if I give them tickets? But obviously there's going to be food there and hot dogs and that kind of stuff. Does that, maybe we're kind of mincing words, but
I would say you probably need to separate the charge at the game. How much did the business pay for the actual food and drink there at the game? That would probably be classified as a business meal. That would probably be 100% deductible. And then the cost of getting into the event, the ticket to get in, is probably entertainment.
Okay.
Which would be zero.
Well, I try to go on a $1 hot dog night so I can really get my fill. So. But that's an interesting one because, again, going back to what you were saying in regards to trying to help the food industry. Certainly the entertainment, like your what's the golf course place? Top Golf.
Topgolf, correct.
That would be great time.
The cost of getting into Top Golf would fall under entertainment.
Yeah,
by the letter of the law.
Okay, man, that's interesting. Okay. All right. Some other things that I'm showing in regards to the winter storm Uri freeze, which a lot of people got hit on. Any kind of tax suggestions or things to think about in regards to that?
Yeah, let's talk about that. Everybody knows last February, February 21, we had the big freeze in Texas. Parts of Oklahoma, Louisiana were also affected. And lots of people had damage at home. Their pipes may have broken. They may have had, catastrophic water damage in their house, pipes, sheetrock, flooring.
Yeah, no, we definitely got hit by it. Were you
No,
unscathed?
we were fine. But the rule on this is you potentially could have a tax write-off on your personal return for any damage you had at your house. But I kind of want to go over the rules on it. In order to claim any loss on any casualty type event like this, because this was a natural disaster casualty, to claim a loss, the IRS says you have to file an insurance claim. So if you have insurance on your home that potentially would cover and help repair some of that, you have to call and file a claim in order to take any tax write-off later. If you just decide, well, my deductible's too high, I think my costs are probably going to be that I have to pay are going to be under my deductible, I'm just going to hire my own repairman to come in and fix it up and pay for it myself, and I'll take a write-off for it on my return for whatever I'm out of pocket on. Technically, you're not supposed to, because in order to claim a loss on something like this, you're supposed to file an insurance claim and let the insurance company handle it.
Okay. Yeah, that's what we had to do. So you have to have some kind of evidence showing that something...
that you filed a claim. Yeah. Now, if you file a claim and later maybe the insurance declines it and says for whatever reason they're not going to cover it, and you have to pay out of your own pocket to make all the repairs, then you'd be okay as long as you could prove you filed a claim, it was denied, you had to spend money out of your pocket to make the repairs. Then you need to recap all that and claim that as a potential write-off on your 1040 tax return. Casualty losses are a write-off, but they're subject to certain limits, which are, again, complicated.
All right. You use the word write-off. What do you mean by that when you say like a tax write-off? We hear that sometimes loosely, but what does that really mean?
Well, a tax write-off is any deduction you're allowed to claim on your 1040 that'll reduce your income sources down to what's ultimately determined to be taxable income. So you'll have all your normal income that your family earns, wages, interest, dividends, pensions, Social Security benefits, whatever. And then write-offs are another word for deduction, where you get certain deductions that you can take against your income every year that help lower your taxable income down to whatever the tax is assessed on.
Nice.
So write-off and deduction are really, they mean the same thing.
Okay. And then in regards to the cost, like, let's say you had $5,000 in damage that you had to pay. How does that end up? Is that going to reduce my taxable income? Is that going to be a deduction, a credit, kind of what we were talking about?
Okay, that's a good question. So let's say out of pocket, your insurance company said they weren't going to cover it. You had to pay $5,000 to repair companies to get everything back to the way it should be. That $5,000 can be claimed on Schedule A, which is your itemized deduction form in your 1040. But that $5,000 deduction will not be totally deductible because it has to exceed 10% of your family's adjusted gross income on your return.
Oh, okay.
So that would mean someone would have to have at least $50,000 or more of taxable income to even potentially deduct some of the $5,000.
Okay,
write-off.
in regards if the damage was $5,000.
So the higher your family's income, the higher threshold you're going to have to meet to be able to deduct any of that casualty out-of-pocket loss. But again, it's something you want to try to key in and let the computer determine whether it's over the 10% or under, if you have a large damage at home.
Nice.
I would say for people that had to pay themselves $800, $1,000, $1,200 to get things fixed, they're probably not going to be able to claim that because it's too small.
Right.
But some people had catastrophic damage. They had, a leak on the second floor of the house and it damaged everything on the second floor. And then the water went downward and went through the first floor. Some people had huge damages on the winter freeze.
Yeah, no, for sure. And just to be clear again, if I made the claim to the insurance and the insurance accepted the claim and gave me that $5,000, there's nothing to do in regards to taxes.
Yeah, you would compare what you received from the insurance company to what you spent. And
Okay.
if you spent a little more than what you got, then the excess of what you spent would be your loss.
Gotcha.
But any insurance reimbursement that you receive, it's not income to you as
Right.
long as you used it to spend it on repairs.
Nice.
And but yeah, you can't claim a loss for something that you were reimbursed for
Okay. Yeah, that wouldn't be
in the same dollar amount.
Gotcha.
Yeah.
Okay. No, that's interesting. Yeah. Good stuff in relation to that. So I guess I'm also, we kind of mentioned it a little bit earlier in regards to the Great Resignation. So I guess inform people a little bit about what the Great Resignation is, and then any kind of relations in regards to, if I can say the word yet again, COVID-19 and anything like that in relation to taxes.
Well, I'm seeing a lot of taxpayers come to me, and a lot of CPAs are probably in the same boat where someone will come in and said, "Hey, I need to have a meeting. I've started my own business. I used to be a W-2 employee, but due to COVID, I got laid off, or my hours got reduced, or the business was shut down for a while, and I decided to start my own business and go out on my own," which is great because that's the backbone of the American economy. Is that we have tons of small businesses that drive our nation along. They
Yeah,
provide
definitely.
jobs, they spend money. So I'm seeing a lot of people needing help with just determining, okay, I'm going to start my own business, but what should I be? I'm not sure. Should I just be a sole proprietor business at home? Should I bring in a partner and a friend of mine start a business together as a partnership? Should I form an LLC, which is common today? LLC is called a limited liability company. And you don't have to have more than one owner to start an LLC. You can be you can be the only owner and start an LLC. But I'm seeing a lot of people need guidance on, hey, I want to start my own business, or I've already started the process. I need help and someone explaining the legal ramifications, the income tax issues that need to be addressed. So it's a big need right now.
Yeah, I totally agree. And it's not I mean, it's just legitimizing, if that is something that you want to do, it legitimizes your business by creating an LLC. But also there's you kind of hear the corporate veil. Can you kind of speak to that? Another reason aside from being able to get these kind of tax deductions and things, like
Sure.
why people would want to.
So the good thing about starting an LLC is here in Texas, if you're going to run a business here in Texas and you want to start an LLC, you need to file a form with the Secretary of State of Texas in Austin. And it's you only file it once. It's a couple pages long. And it's basically you can file it as an LLC or you can file it just as a straight corporation. But basically, what you're doing is you're telling the state, here's my company name that I want, here's my mailing address, here's who's going to be the owners. And you send in a $300 filing fee with the paperwork, and the state will process it, and they'll send you back the forms that says, hey, we've approved your company. And you can decide how you want it structured. You don't have to be an LLC. You can just be a straight corporation where your name would have corporation in it, or Inc. or something. And you don't even have to file papers with the Secretary of State in Austin if you want to start your own business. You could have your own business. It's not an LLC. It's not a corporation. It's just what's called a sole proprietorship, doing business as a certain trade name. So, and in that case, you don't file any papers with the state of Texas to get the company started. You just start up your company with whatever doing business as name you want, as long as no one else in your county that you're in has that same name.
Okay.
So,
yeah. And then, but again, isn't there a reason in regards to if for some reason the business gets sued or people kind of do some like leveraging against it, having that corporation or that business formality can definitely help you. Can you talk to that a little bit?
That's a great question, Steve. Yes. When you form an LLC or a corporation, the good thing about doing that is that once it's formed and you start operating your business as that company, You make sure all your stationery is in the name of your company. Your business cards show your company name, not just your name only. If you make it clear and you run your business as a LLC or a corp, the owner of the business gets legal liability protection. So yes, in case something later goes wrong with the business, maybe out on a job site, an employee of the business or the owner who's conducting the business, maybe something goes wrong on the job site and the customer has a claim to sue, they would have to sue the LLC or the corporation instead of suing the owners individually.
Right.
Which is a big benefit, for companies that maybe are in hazardous industries, real estate, construction, maybe the medical field. You probably would not want to practice as a sole proprietor if you think the risk of potentially getting sued is more than minimal.
Right.
Anybody can file a lawsuit. It's easy for any plaintiff to go and file a lawsuit. Once a lawsuit's filed, then all the work is on the defendant who has to defend, why he didn't do anything wrong. So it's pretty simple and easy to get sued. And if you do get sued, you'd probably want your business to be an LLC or a corp so that your personal assets are protected from any lawsuit claim.
No, that's great. So anything else in regards to, the people that maybe think about starting their own business or something, or just a home, any kind of business out of their office, since there are, things that make it a lot easier to do that. A lot of times you hear about, home office expenses and things like that being written off. Any guidance on that or suggestion?
The IRS does have a deduction for home office expenses if you're using part of your residence to run a business out of. There's a home office write-off for the square footage that you're using specifically for a little work area compared to the total square footage of your home. You can do that little allocation and be able to write off some of your home's insurance, some of your home's utility costs, some of your home's property taxes, upkeep on the home. A certain percentage of all those total costs could be written off as a business expense pursuant to that allocation ratio. So yes, the deduction's not huge, but every little bit helps.
Yeah. And I mean, I can't recall if you mentioned it earlier in this, but the standard deduction is so high that it's you got to really be doing a lot out of your home office in order to get above that standard deduction.
Yeah, I'm glad you brought that up because, again, beginning in 2018 when the new tax law went into effect, previously to 18, if you were an employee of a company but you were working from home out of your home office, you could write off some of your home office expenses as an employee based on that allocation percentage of whatever the square footage is. Beginning in 2018, the IRS got rid of that home office write-off for an employee who's working at home for the company that he's employed by. The only home office deduction available now is for truly self-employed people who are working out of their home with their own business as a self-employed sole proprietor. So employees of big companies cannot take the deduction anymore. It's only if you have your own business at home can you write that off.
Okay, yeah, that's interesting. Pretty fortuitous of them, huh? Because, I mean, so many people were working out of their home for the last 2 years, although people are starting to go back. But and you talk about that percentage allocation. So can you speak to kind of what that breakdown is, how you come up with that percentage?
Yeah, you just estimate the square footage in the room in your house that you've got set aside for your little home office. The IRS says you really can't use that room for anything other than your business. So try to pick in your a room in your house that, a spare bedroom that's never used for anything else, or maybe a little den area that's not used for anything, and set up your home office there. And then you take the square footage of that room compared to the total square footage of your house, and that's the ratio that you use to calculate the home office write-off.
Okay, and then that same allocation that's going to be the same that you use for your utilities, your mobile phone, or anything like that?
Yeah, so if the little small room you're using is 10% of your total house's square footage, then you get to write off 10% of your total utility costs that you pay on the house, 10% of your insurance premium that you pay, 10% of any repairs to the house,
Okay. And then, of course, all of that needs to add up to that more than the standard deduction when you're doing your
No,
itemization.
for someone that has their home office business on their own, they're going to be filing their business on a Schedule C,
Okay.
profit or loss from a business inside their 1040. And on the Schedule C, there's a special line for home office expenses
Oh, nice.
that's not subject to the standard deduction. You get that automatically.
Oh, great.
And it's the standard deduction is on top of your home office expenses. So,
good to know. Yeah, I wasn't aware of that. That's awesome.
yeah, the thing they got rid of, the IRS got rid of, was home office write-offs for employees who work for big companies but were working from home. That did normally apply toward the standard deduction, but see, they threw that out. So employees that work for larger companies can't do the home office expense anyway.
Gotcha. No, that's good. So sometimes in relation to the home office, or there's maybe some red flags. Are there some things that are kind of like red flags that maybe if you do this, maybe that might trigger an audit, if we can say that word? I don't know.
Yeah, that's a great question too. The main form in your tax return inside your 1040 that's going to cause an audit flag, and I see it all the time, is what we've been talking about, the self-employed Schedule C profit or loss from a business form. On the Schedule C, it shows gross income that your business collects, and then it has categories from A to Z of the various expense categories, from advertising all the way through Z. You list them by totals, by category. And the one thing I see that is an audit flag is if you have very low income that the business collects, but large auto expenses, large home office expenses, large supply expenses, to where after all the expenses are reported, you end up with a loss, and sometimes a large loss on your Schedule C. And the IRS looks closely at those because they know, how would a business be running if it has very little income and large expenses? How is it going to be a viable business?
Right. So start looking at, is this person's last name Soprano or anything like that? So awesome. Well, no, that's pretty good stuff. Do you have anything in regards to some in relation kind of directly with this kind of stuff that we've been talking about? I've got a few other things that I wanted to kind of bring your way, but I didn't know if there was anything else.
I would just say if you're really unsure of anything in your tax return, especially if something unusual has happened during the tax year, and you don't feel comfortable preparing your own return with the take-home softwares there are, it doesn't hurt to contact a trusted professional. And just sometimes you end up calling a CPA and he'll answer a couple questions quickly over the phone, and they don't charge. If it's some quick answers, I would just advise people, if you're unsure, it's best to get an answer from a tax pro. That way, when you file your return, you're pretty confident that the IRS won't find something wrong with it.
Yeah, and I think that that brings up a good thing to do, that I'm sure you're probably going to be much more nicer to answer a question or two, today or in the March time, but come April or April 15, maybe not so much, huh?
Correct.
So yeah, definitely be diligent and go think about that. And I think the taxes too, that kind of makes me think about that. Again, we think about taxes April 15th, and once we kind of start getting our W-2 forms. But again, it's something that you should maybe think about every kind of 3 months, right? Like every quarter, kind of look at things.
Especially if you have a small business that you're running, you kind of want to know during the year, if you have higher than expected profits compared to the prior year, you probably would like to know what tax you're looking at beforehand and not be surprised on April 15th.
Excellent.
As with anything, if you start your own business, it's probably best that you just meet with a professional. It could be a lawyer, it could be a CPA. It doesn't have to be a CPA. There's lots of tax professionals that aren't CPAs. They're either enrolled agents or they've done taxes for many years. It's always best to meet with them or call them and get answers to your questions before your business gets going too far along, because if you don't get the proper advice up front and your business gets a year or 2, 3 down the road and you find out you were doing something incorrect, it's kind of hard to go back and fix things.
Yeah, and that brings to mind that, like you're saying, if something did happen, over the last 3 years or 5 years, you can get kind of stung. And could they go back to those prior tax returns and do anything?
The IRS has a rule: once your tax return is filed, this is any tax return, whether it's a 1040 person return or if it's a corporate C Corp or S Corp return, once the return's filed, the IRS has 3 years from that date going forward to want to be able to look at it, audit it, send you a letter saying they want to audit it for a certain issue. So once you file, there's a 3-year window going forward where you're potentially at risk for anything that might be an error in the return or something the IRS finds out they want to disallow because maybe you didn't follow the rule correctly. So it's not like you're at risk forever. There's only a 3-year window.
Okay.
And if the IRS chooses not to audit you within the 3 years, once the 3 years passes, you're good. They can't later go back and audit a return older than 3 years.
Okay.
The statute has expired for the IRS to change it.
Nice. No, that's good to know. And then as far as record keeping, how should we handle our record keeping?
I would say similar to the 3-year rule for the IRS having the ability to change your return, I would say keep your important family and business records for at least 3 years back.
Okay. Yeah, that sounds like a good rule of thumb to, see if they're going to do anything. And certainly, if you are doing a lot of these business things, you want documentation all the time. So yeah, definitely
Right.
good to keep that up too, for sure. Awesome. Well, I can't support Patrick enough in regards to what he shared today, because taxes are something that you should give a little bit of time to throughout the year. And obviously, this time of year, certainly a lot more attention. But I would definitely reach out to him or someone else that you feel comfortable with, just to, again, get a second pair of eyes, because I've definitely learned a handful of things today, certainly in regards to the child tax credit and the freeze. We were definitely hit by that. So, yeah, good stuff. Thank you so much, Patrick.
Appreciate it, Steve.
All righty. What are your deets if somebody wanted to reach out to you?
You can find me on the internet, Patrick Cooper and Associates, CPAs. I'm here in Pearland, and my phone number is 281-485-6600. Like I said, if you already have a CPA and he's doing a good job for you, I would say stay with him. I did this program today for just to share knowledge with people. I don't mind you calling me at any time. That's fine. But I did this program today with you, Steve, just to get the word out that there's a lot of tax credits and opportunities for people that if they don't know about them, they won't take advantage of them. So the government put them out there for people to take advantage and to help them. So
awesome. Well, I hope that everybody will reach out and hopefully lower their average tax rate. Thanks to Patrick. So awesome. Take care.
Appreciate it.